Hey, Jenna.
Trying to be safe out here driving.
Thank you. Your video's on. We can always see you're a safe driver. All right. Good morning, everybody. Happy Monday. How you guys doing?
Good morning. Nice and
Very,
frosty.
very, yeah, very, very cold out here.
Yeah, it's a chilly start, isn't it? All right. Start off with a little gratitude. Well, before we do that, is everybody ready for Christmas or where are my procrastinators when it comes to buying presents?
That's me for sure.
Yeah, I
I
see
finished
Nathan
yesterday.
and Zach. Yeah. It's funny. Yesterday I'm sitting there going, oh my gosh, hey, Christmas is like within 2 weeks. So in between, I did some work in the morning and then I was trying to watch some football yesterday. But while I was watching football, I was also like, what? And there were some gifts I was looking for. And then making certain, of course, I could get them in time. So
Thank God for Amazon.
yeah, thank God for Amazon. Amazon looks like it will complete my list. So good stuff. Good stuff. All right, gang. So let's kind of jump into this. If you recall, last week, as always, we were looking at at a different like report from a different source that I also have. And there was one thing that showed up in there. We were talking about the rapid run up in the average list price in the 28277 zip code. I think it was between what March and like June over a 90-day period of time in 2023. And I said, what do you think was causing that? And I kind of gave it to you guys. I didn't kind of, I gave it to you guys as sort of a homework assignment. Anybody do any research on that or do any deeper dive into that at all?
Apparently not.
Well, thank you, Nathan, for speaking for the group. So what I'll do, the good news is I did. So let me go to screen share here for a minute, and I'll just kind of refresh our memories on this. Go here first, and here real quick. Oh. All right. Stop share. Here, hang on a second, guys. Have a review. Let's go to screen share here real quick. All right. Here's what I'll go over here to this one first. Minimize this. So as you remember, this is the one that we were looking at last week. We have 7-day median and 90-day median in this particular report. And on this one, this was the median list price. And this is what we saw in for March 3 with a 90-day median list price of $625 over the next 90 days to June 3. We had a 90-day median list price of $939. So we went up from $625 to $939. That's roughly right around 50% increase in the median list price in 90 days. That one stuck out to me when I was first looking at this particular chart, getting ready for last week's call. And when I saw it and I looked at it, I'm like, oh my gosh. I mean, that's a significant run up in what was causing it. Because by now we already had the higher interest rates, didn't we? Because the interest rates were starting to rise coming in here, like going back into July, August of 22. And we can kind of see this as interest rates were going up. Look what was happening to the median list price overall in the market, right? It was starting to go down. And then all of a sudden, here we go in this, March period of time, again, for 90 days to see that significant run up and that median list price. What in the world is going on? All right, so let me kind of debrief this a little bit more for you. I'll break this down. If you recall last week, we could hit market segments. And in market segments, what it does, it's taking the price ranges in the 28277 zip code, and it's breaking it down into median prices, 4 different median price levels. Okay, so here's what it's saying. The top 90 the top segment is right here with a median price of 1.4. The upper segment is right here with a median price of 802. The lower is 725, and the bottom median price is 578.5. So that's the segments that it's marked, that it's broken this data into. Well, now if we go back into the chart, now that we have asked for this to be broken out by market segments, by those prices, here we go to, let's get to 2003. Here's February. There's March of 2003. Okay, if I look at the bottom didn't have a significant increase. The lowers had a slight increase. The upper had a slight increase. And if we really look at it, the big increase that we're talking about happened in that top segment. Well, if I come back up down here to the top segment, the median price is 1.4 million with about a 4,400 square foot average, sitting on a quarter to half acre with 4-bedroom, 4.5 bath with an average age of 24 years.
What does absorbed mean, Chip?
Absorbed, we're going to talk about that. Actually, I'm going to give you the first call in January that we get to. I'm going to talk about absorption rate versus months supply of inventory, because it's 2 different things. And I think it's really important that we understand it. So that'll be something I'm going to talk about in January, Nathan, if you're okay with that.
Yeah, I'm glad we're going to talk about that one. I was going to suggest that we cover that on one of these calls. So good.
Yep, you're welcome, Sharon. My pleasure. Yeah, it's kind of popping up in a lot of the data and research. And in the other market center too, up at the lake, we had a conversation about it at a team meeting last week. And it was such a small dive into it. I said, I'll actually prepare some things so it could be like a mini class on it. So yeah, I think it's important. to understand.
Hey, Chip, I think he was actually looking for the definition of absorbing and the absorption.
Oh, got it. Okay, so absorbing is just simply it's what's absorption is really the difference between what's available and what's being taken off of the available inventory. That's the quickest definition I can give you. Okay. Is that all right, Nathan?
Yes, thank you.
Yeah, you got it. All right. So back to this. So here we go. We see the run up here in March. So the run up was in, again, this higher price point. And if you really look at it, here we go. I mean, even going into May, look what happened. March to May, we had a significant increase. It's just crazy to me, like what we saw. All right, so I broke this down a little bit more. Remember the median price, 1.4. So in the median price in this top segment, the median price is 1.4 million. Here's what that means. It means 1.4 is the middle. There are just as much below and above the 1.4 that kind of equals it out versus looking at it from an average perspective. So what I did is then I went over to SAM reports and MLS. I go, okay, here's what I want to know. I want to know in 28277, a million or more up. And it's probably closer to about 1.1, but for the sake of what we did here, I went to $1 million or more. And I wanted to see what the new listing activity looked like for that period of time. So if we look at it coming into, here's here's May rather, even April of 22. Okay, so in 28277, we listed 66 and then 72. We had a little bump here in August of 22 of about 82 units. And then it started to go back down into the 70s, kind of hung out in the 70s pretty much every month. About 74, 75 new listings coming on. Here we go, January of 23, we had 74, then we had 79, then we had 85 in March. March of 23 is where this started, it was March 3. So we listed 85 homes, a million or more in the zip code in March of 83. And that was the first time we had been at 80 or more. It really kind of started in February, maybe it was 79. But the official hitting the 80 mark or more started in March of 2023. Here we go, April, there's 91. Here's May, 96. Here's June, 98. So we went from the amount of listings coming on the market from being in this mid 70 range to close to 100. It was 101 in July of 23. What do you think the cause of all of this different inventory? Because we're talking there even about a 30% increase in the amount of listing units hitting the market into 8277 in that price range. What do you think was causing it? One word. Begins with E.
Equity.
Equity. Thanks, Zach. Equity. Where's the greatest equity in the market at that period of time? Because remember, if I go back over here, what was the average age of those homes? 24 years. So imagine if, I'm not saying that every listing that hit the market, somebody had lived in it for 24 years, but knowing a little bit about 28277 and knowing the million or more market in that zip code, which is where the office is located here in Ballantyne, if you start thinking about it, there's a high likelihood that a lot of the folks have lived in those homes for a while. Think even Ballantyne Country Club. So if all of a sudden these folks were sitting on significant 6-figure or higher equity, was there some uncertainty in the market during that period of time economically? Just in general economics? Yes. Was this the opportunity for people to pull cash out of their homes to do something else with the cash. It could have been that there was an opportunity in the market. It could have been that there was an opportunity for people to say, you know what, now might be a good time to change the real estate landscape. Let's downsize, let's upsize, multi-generational homes, whatever it is. At the million or more, I'm sure a lot of these folks were probably diversifying their real estate by, it could be real estate investment opportunities. They were probably more downsizing, although some of the data even suggests that the average age of the home sellers in the last 12 to 16 months has been in their 60s. And more than half of those folks that sell actually upsized. Now, the biggest reason that they're upsizing is coming a lot of times, believe it or not, from multi-generational housing needs. Aging parents, adult kids, all of it, right? So I think what this really is, if you start thinking about it, if somebody is sitting in a $1 million house, or $1.2 million, or the median price of $1.4 million, and they were sitting on at least 50% equity, and there's a significant chance it was a big chance it was higher than that. Think about it for a minute, guys. You're talking about $500,000, $750,000, $1 million in real estate that's just sitting there. It's going unused. If you were in that position and your housing needs were changing, regardless of what was happening with interest rates, would you list your house, get the equity out, and go change what you needed to change personally for your living situation? Now, there's one other caveat to this data point that we're talking about. This stat is, what is this stat again that we looked at? It was the median list price. And over here, we're looking at new listings. So guys, these were the list prices. These weren't necessarily the sale prices. So let's look at closed sales for the same period of time. So again, remember, we got 1 million or more. We're still in the same zip code. Let's get down here to April. We'll go to April. So here's March. We closed 81. Isn't it funny, in April, we only closed 71, but then, because here's the new inventory that started to come on the market, remember, early March of 23. So we had a higher amount of supply coming on the market. That first month in April, we didn't sell as many as we did in March, but from there, then we started to climb back up. And by the time we get to June, we're at 79 units sold. And if I come over here to new listings, was 98. So really, we were closing about 70%, 72% of the inventory that was coming on the market, roughly was coming off the market at the same time. And if we look at what happened by the time we got into July, August, remember, some of these cycles would be a little bit longer in terms of days on market. Now we start ticking into the upper 80s, 87, 88, 88 over the next 3 months, beyond when this surge started in new listings. If the average days on market was about 90 days, here are the pendings, or really, here's the closings, if you will, from 90 days later when that surge of new listings happened. So how important is inventory to the market at any price?
Very.
Absolutely. Absolutely. I wanted to walk us through, and I wanted to give you guys that homework assignment, because what I wanted you to do is get your brains into information to get kind of living curiosity around what could potentially be driving an anomaly in the market that we saw over here. Because by the way, what if you were talking to somebody and you shared this graph and they go, hey, it looks like there was a significant increase from March until June in this one price point. What was the driver of it? So what I'm trying to get you guys to do is find your other resources and go back in and look at things in a way that gives you the ability to have the conversation, that you can say, this is what it looked like was going on. This is how the market actually was kind of functioning in this price range or this area or both during that period of time. Like I could click on in the SAM report for that same period, of course, I can look at pendings. So here we go, March. Let's go back here to February, 64 units pending, 64 units pending in March. We get to April, 73. Well, it's hard to pend something. It's hard to buy something that's not on the market. And I'm not saying there wasn't properties on the market, but again, if the properties that were active that hadn't gone under contract yet had already been viewed or looked at, and they weren't going under contract, the buyers weren't interested in that, were they? But where the buyer activity started picking up here in the pending sales, all was driven from that new inventory coming out of the market. It started to spur additional activity. So again, another way to look at how important is fresh new inventory hitting the market all the time. How important is that to us? Because here we go, by the time we get to August, 87 pending. If I go back here to August of the prior year, 64 pending. Just one little price point, not so little, but one single price point in one zip code, and look at the difference it made in the amount of pending units, because that difference, even down here to 64 to 87, 23 units different month, in a monthly comparison. That's about 23 to 30 million, let's say, at $1 million or more in active, pending, and closed value. All right, what are your thoughts, comments, questions?
I was looking at the chart. I'm kind of curious about how the days on market are affecting the luxury market and why the middle to entry points are significantly staler.
Okay, so let's go back. Are you talking about currently, Nathan?
Well, just according to the Altos graph there.
Got it. All right. So yeah, let's look at this while we got it. All right. So here's what I tend to see over in my real estate career is that the luxury market usually, in a local market, the luxury market usually shifts before the rest of the market shifts. For the purposes of this call, let's just say the luxury market in this case is $1 million and up. So usually we're going to see more shifts at the luxury point, and usually, of course, the big tell on this is that we usually see it trend downward first. You could have a very healthy overall market, but you have to keep an eye at certain segments of the market too. So if all of a sudden if I started to notice right now that there was a current decline in the amount of luxury pendings, if I saw a decline or an increase, let's say on days on market, or if I saw anything that was kind of a situation where it was indicating a downward trend at that luxury price point, usually what I'm going to expect to see is probably within 6 months, it's starting to impact the other price segments. Okay. This is why it's important for us to kind of look at it from this thing. In fact, just look at right here, even if you will, look at those significant swings here, like late 23 going into, again, that's early spring, that March period of time in 24, and then look at the drop off in that median list price. Kind of crazy what this thing is doing. We see it a little bit here at the next tier, and then by the time we get down into what would be probably deemed as the more affordable pricing segments, the more active segments, there's less volatility in those swings. You see some slight trends here trending along with the upper price points, but it's not the significant swings that you would see. 42 days. So here's the deal compared to the 91s and 98s and 70 days. I really believe here that, again, at the luxury price point level, if somebody's sitting on a ton of equity and they were going to go from the luxury segment to the luxury segment, just maybe a different location, different type of house, maybe a little smaller, maybe a little larger, maybe a little newer. Don't forget they've got a lot of equity at play. And because they have a lot of equity at play, some of these could be cash purchases. Some of these could be the fact that they're obviously highly qualified financially to do it. So the demand in the market is significantly stronger. if I look at it right now, so here's what it's saying. We're seeing a little bit here of an uptick as of December 12th. In that medium price upper segment of the market, okay? So right now, as of this period of time, December 12th report, we're looking here at 42 days compared to our 90s and 98s down here. So there could be some tax implications for people that they need to act a little bit quicker. That could be driving some of this. It could be that there's more demand, less supply, so that, you know, because we haven't maybe seen the same amount of supply hitting the market. Let me see if I have that on this one. Inventory. No, that's not the case. We got broken up by market segments. We're seeing a lot of inventory here. Well, 20. It's showing, looks like 20 to 21 units. So I would say it's probably more demand than there is supply. Currently, at least in the last probably 30 days. That's driving the slower days on market. We're down here, we probably are going to have a tendency to see more of these homes on the market, therefore more inventory, lower demand, not low demand, but lower demand. So it's taking a little bit longer. But ironically, if I look at this one here at the 578 price point, of course, I would expect this to be pretty active, right? Because this is probably, sad to say, this is going to be where your first home buyer price point is, which is pretty significantly high. But that's probably going to work a little bit closer. And then we have to look at it too, Nathan, like even here in the 725 and the 802, these middle two, how many of those, don't forget, these are medium price listing prices. Are they realistic? Are these the sellers that are like, if somebody gives me 800, I'll sell it, even though there really is, you know, a 750 or a 725. So there's a lot that goes into this, and we could probably go over here to Sam and look at some of the, get a clearer answer on that if we wanted to spend time doing that right now. All right, anybody else? Any thoughts, comments, questions? Here's your 28277 as of today, Monday, December 15. Here's your median list price. Median price of new listings, price per square foot, average days on market. This is everything. This is the entire market. This is not broken up by pricing segments. Median day, average days on market 86, median days 70. 53% of the listings had a price decrease, 5 had a price increase. 6% of those that came off the market, remember, either expired or the contract fell out. This is what they in this report, that's what they call an off-market property. 6% of those have relisted. Here's your total inventory, 66 units in the zip code. Here's the median rent for the market, down a little bit, about 25 median rent. And then we're still at a slight seller's advantage when we look at this market action number of 40, with 30 being the kind of balanced market. And then anything below 30 is buyer's market, anything above 30 is seller's market. All right. Thoughts, comments, questions, ahas? All right, great. Don't forget, guys, as a reminder, the next 2 weeks, we will not have this call. We will come back on January 5. I believe that's that Monday. First Monday in January, we will talk about the difference between month supply of inventory and absorption rates and what each of them, they're very closely related, but at the same time, there's differences. And if you know them both, it actually kind of gives you a better understanding of how some of this stuff, you know, what it really means. So I hope you guys have a great, safe, enjoyable holiday couple of weeks. Take the time off, enjoy your time with loved ones and friends, and celebrate and have fun. Lord knows you guys have worked really hard this year. Numbers show it. You have a big year coming up, big opportunities, and we're going to make certain you're ready for it. Take care, everybody.
How about them Bills?
Go Bills.
Thanks, Chip.
See you guys.